Chapter 6, we start the audit process, and we're going to specifically talk about the audit responsibilities and the objectives. So the steps to develop the objectives are that we've got to understand the objectives and the responsibilities for each audit that the companies are undertaking. They then need to divide the financial statements into different cycles. They need to understand management's assertions about those accounts, and then know the general audit objective for each class of transaction and account. So like we'll get into more details on that, but is it a sales transaction? Does it create an accounts receivable? So how do we audit sales, and then how do we audit that balance that's in the accounts receivable account? So that's an example. And then know the specific audit objectives for the class of transactions, accounts, and disclosures. So I can add disclosures to that as well. So those are the things that are the steps to develop the audit. So the first step is to identify again what we're doing. So our goal of an audit is to issue that opinion regarding the presentation of the financial statements. So are the financial statements free of any material misstatement? Can we issue an unqualified or a clean report or unmodified report, or do we have to have an explanatory paragraph, or is there going to be a disclaimer, whatever? So that's our issue. Our primary focus is to prepare the audit report that issues a statement regarding the presentation of those financial statements. So they need to obviously use due care and exercise professional judgment and follow their generally accepted accounting standards. Again, taking that back to Chapter 5, that's their defense, that they'll have no lawsuits, no one could come after them because they did everything correct. So then what is the client's responsibility versus the auditor's responsibility? So the client's responsibility is for actually preparing the financial statements, and then the auditor's responsibility is basically just verifying that those statements are providing reasonable assurance that those statements are free from any material misstatement, and that they can be they represent the company to without, again, they're not making a guarantee that everything's 100% accurate, just providing the reasonable assurance that these financial statements can be relied upon. So again, the client's responsibilities, the CFO or the CEO are going to sign off on those statements. They also sign off that they've established and maintained effective internal controls, to support their accounting processes. And then the auditor's responsibility will then be to communicate their opinion on their audit report. So then when we're focused on what is the auditor's responsibility, they're responsible for discovering any material misstatements that may happen due to fraud or error. So that is the responsibility of the auditor. So then materiality comes into play there again, because we're responsible for discovering material misstatements. So a minor misstatement is not going to be anything to raise the red flag about. It would have to be material, and that goes back to each audit individually. And then the real key is, would it influence a reasonable decision, a reasonable user's decision on those financial statements? So maybe a bank to give a loan or a stockholder to buy stock. So if it's something very small in comparison to their dollar amount of assets, it's going to be immaterial. So materiality always comes into play, but again is unique to the audit that you're on. So again, the reasonable assurance is not a guarantee. We've said that like in probably almost all of our chapters so far. And the reason we can't guarantee anything is all we're really doing is taking samples when we're performing our audit tests. A lot of times there's very complex estimates that are in the client's financial statements, and the audit managers can talk to the clients and figure out how those were calculated and make sure they're comfortable with how they prepared those estimates, but they're still estimates. And then if you have think of like Enron, where you have top level people who are involved in creating some sort of a fraudulent scam. It's going to be harder for the auditors to find those because they're going to definitely cleverly conceal them because they don't want to get caught. So then we talk about again, error and fraud are our two types. So error is when it's just an unintentional mistake or an omission of an entry or a transaction or an account or something like that. So it wasn't on purpose. They're not trying to defraud anybody. But a fraudulent one would be an intentional misappropriation of assets or a fraudulent financial reporting. So misappropriation of assets is somebody is stealing something. So maybe they're taking cash deposits, maybe they're stealing and selling inventory. Fraudulent reporting is when they're kind of more like, I guess, I mean, Enron also, they might have been taking money too, but they definitely were fraudulently reporting their financial statements. So their users thought that they had more income and they had more assets and equity than they actually did. So they're overstating income or they're overstating assets or showing that they have more equity than they really do. All of those would be examples of fraudulent reporting. And then there could also be illegal acts. So we have direct effect legal acts and indirect effect legal acts. So direct effect legal acts have a direct financial impact on the company. And then an indirect effect illegal act would not have direct impact on the expenses or the payables of the financial statements, but if caught or prosecuted, they could have fines. So an example of that would be like they're breaking environmental laws. So they're dumping toxins into Lake Erie, and if they get caught, you uncover that, and they get caught, you know that they could end up with fines and obviously a lot of bad publicity. Auditors are not there to look for illegal acts. It's not like we're working for the FBI and we're trying to uncover that stuff. However, when they review the minutes of the board of directors, or they always reach out to attorneys and send the attorneys a questionnaire at the end of the audit to see what's out there. When they're fishing like that, they might find some information that could expose some illegal activities. So if those are identified in like that litigation inquiry, their responsibility is to disclose whatever they find out and communicate it to the board of directors and or the audit committee. So all the attitudes, we've talked about these in our past chapters as well, but anytime we're dealing with an audit, these are two of the prime characteristics or attitudes that the auditors need to maintain. So they need to exercise professional skepticism, where they basically kind of look at everything with a questioning mind and kind of critically assess it. So you talk to the client and you hear what they say, so you trust them, but you still go through the actual effort to verify it. Just because they tell you they took a physical count of inventory and this is the balance, you don't just go, oh, okay, great, I'll use that. You actually go and you're a part of that physical inventory count. You go and randomly, test different items and verify the count sheets and see that they're following the proper internal control procedures and that type of stuff. So the elements of that is that you have to have a questioning mindset. You have to be suspend your judgment. So again, that could be positive or negative. I mean, say you think, oh no, I think they're great and they're doing everything right. That would be, in a sense, a judgment that you're saying that, you know what I mean, you've already made your decision or whatever based, or it could be negative. Search for knowledge, which would happen again through our audit testing, interpersonal understanding, and autonomy. So again, always keeping your independence, and then self-esteem. So those are characteristics of professional skepticism. And the self-esteem, let me just to clarify that a little bit, is to just resist persuasion and to challenge assumptions. Because again, think about many times who your audit people are. They're right out of college. So I mean, they might be talking to a guy who's been doing, working at this company as the controller for 25 years, and you're 25 and right out of college. So you still have to have that kind of that self-confidence that says, I'm not going to just listen to this client just because he's been here so long and he's, talking in a very authoritative voice. You still got to challenge those assumptions and do your job. Okay, then professional judgment. So professional skepticism is a component of professional judgment. So professional judgment is identifying what the issue is, gathering relevant information, identifying if there's potential alternatives, make a decision, and then complete your documentation and your rationale for your conclusion. So your judgment tendencies would be that you could have confirmation where you've already decided, like you've already thought, hey, I think this place is very trustworthy and they make good decisions. And then you ask a few questions to the or to the client's management, and you're confirming that and thinking, okay, my initial belief was that they were good, and now I've confirmed it. I'm moving on. Overconfidence is the tendency to overestimate your ability, or make accurate assessments about the risk. So you always got to kind of challenge every opinion and challenge underlying assumptions. Kind of again keep that professional skepticism in your work ethic. Anchoring is the tendency to make an assessment by starting with that initial value and then adjusting it insufficiently. So what you really should do to avoid that is to solicit input from other people, consider if there's any management bias or potential for fraud. So again, it's kind of more like keeping that open mind. And then availability is the tendency to consider information that is easily available or easily accessible. But sometimes, the clients are counting on that. So then that's going to be information that's going to, obviously not, if they're trying to cover something, it's going to be the information they want you to get. So sometimes you have to go a little further and consult with others and kind of consider some objective data and to go a little deeper into the documentation. All right. Then our next step gets into our different financial statement cycles. So we have the cycle approach to segmenting the audit. So we're going to keep all of our related accounts and activities kind of in that same segment. So we have our sales and our collection cycles, so billing out customers, looking at the accounts receivable balance. We have the acquisition and payment cycle, so our accounts payable department, we get invoices in and how often do we pay them, and our accounts payable account. Payroll and personnel, so obviously cutting paychecks, looking at time records. Our inventory cycle, which could involve purchasing inventory, but it's probably more how do we maintain the inventory, how do we issue it out to the jobs, then how do we charge it off when it's sold. And then our capital acquisition and our payment cycle there as well. So that's going to be more of like our long-term capital assets. How do we maintain those? Do we, some companies will have little like serial numbers that go with every fixed asset, so they know when they dispose of one to take it off the books, all that kind of stuff. Or a new one comes in, how do they set that up? And then there's transaction related objectives, and then there's balance related objectives. So transactions are things that like recording a sales invoice or entering an accounts payable invoice or transferring inventory to a job. Those are all like transactions. The balance related things are like, well, what's in my accounts receivable balance at the end of the year, which relates to those invoices that we send to customers, but what's left at the end of the year in that balance? What's left in our inventory account after we've transferred stuff to jobs, what's in our accounts payable account, that type of thing. Then our step 3 is our management assertions. So the criteria management uses to record information. So existence. So is it actually real? Just because they have all these fixed assets on their books, do they legitimately exist, or could some of them be fictitious? Could some of them have been added? Could some have been sold and not removed from the ledger? So do they physically exist, or if it's like more of a transactional thing, did it actually occur? Did that sale that we see an invoice for, did it really happen? Completeness is that all of the transactions that should be presented in those financial statements are there. So if we're looking at them as of December 31st, is everything included in there? Again, because there could be maybe issues with their cutoff process, that some items are missing. Maybe it's intentional, they didn't put something on the books. Then we have valuation and allocation. So again, looking at our financial statements, our assets, our liabilities, our revenues, our expenses, are all of those in at the proper amounts, and are our financial statements accurate? So then I have in parentheses there, like, consider even the estimates that we use for assets and depreciation, or valuing inventory. All of those things kind of would go into that category. Rights and obligations, do they really hold the right to the assets and the liabilities on their balance sheet date? So that's what makes it, date specific, because we're looking at our assets and our liabilities. So on the balance sheet date, did we really own it and have title to it, or did we have the loan in our names? And then presentation and disclosure is that the financial statements are properly classified and described and disclosed. So the auditors are going to go through and they're going to test all of those things. They'll look at transactional audits to make sure that all items that should be included are, and then they're going to look at the balances on different accounts. So are they at the correct values, and are they in the correct classification? Current assets, long-term assets, current liabilities, long-term liabilities, all that type of stuff, like to our financial statements. Then we get into our transaction-related audit objectives. So we have occurrence, again, that it actually occurred. Completeness, that all the transactions that should be recorded are recorded. Accuracy, that they're at their correct amounts. Posting and summarization, like as you read through the textbook, like and as you work in the work world, that all happens within your IT program. So depending on what type of software you're using, that's happening behind the scenes. So the auditors just have to get comfortable with that programming, that everything's correct, maybe do some testing, maybe talk to the IT people, whatever gets them comfortable. But then once they know that that's all happening accurately, they can just rely on that information. Classification, that things are posted to the appropriate accounts and that they're at the correct dates, the timing element. And then presentation, so that they are appropriately aggregated, and if they're making disclosures or if they need to make disclosures, that those are made and those are relevant. So again, tying kind of back to our complete financial statements. So balance related versus, I think, transactional related is what we're going to have on the next slide. So balance related audit objectives. So those are like, okay, I'm looking at accounts receivable and I want to know, is my accounts receivable balance that's on my balance sheet accurate? And how can I get comfortable that it is? So these would be the types of things that they're going to look at. So they're going to have the same that I mentioned previously: existence, completeness, accuracy, classification, and presentation, and then disclosure. So those are on the last slide. But in addition, we're going to look at cutoff testing. So is it recorded in the proper period? So inventory is a really, really hot one on that standpoint. What is their policy for what do they include in inventory? Like, was it shipped out today, and was it freight on board, or was it freight on board shipping or destination? Some of those different unique scenarios where maybe it's freight on board shipping point, so then it shouldn't be included in our inventory because it left today. But if it's freight on board destination and it's still en route, it should be on our inventory. So those are very unique kind of scenarios. Or what if we have consignment stuff that should be in there or not in there? But that doesn't kind of go into cutoff testing. So cutoff testing is more that timing to say, okay, if I'm taking inventory on this day, I need to make sure everything that should be in inventory I've counted and I've recorded properly, or everything that should be in my accounts receivable. Well, what about checks in the mail? Those kind of scenarios. Then you can have detailed tie-in where you take a specific transaction, such as like a sales invoice, and you tie it back into the account detail, and then you take that account detail and trace that into the ledger balance. So accounts receivable, take one customer's invoice into the accounts receivable subledger, then take that customer's total into the total accounts receivable balance, and then take that all the way into the trial balance. Realizable value, that assets are included at their true amounts, so that if you have any obsolete inventory, that's been written off. If you're looking through your accounts receivable, have you done a proper bad debt analysis to write off the people who haven't paid and it's been over 90 days and you've done all kinds of things to collect? The rights and obligations would look at your assets owned or your liabilities owed. So maybe even, you're going to test some of those documents to make sure you had legal rights to that asset, again, on the balance sheet date. So then the phases of the audit process, we're going to plan and design the audit approach. And within that audit approach, we need to make sure that we are getting the right amount of evidence. And that, again, because you could say, well, the more evidence I get, the better. But then you have to also look at the cost of gathering that evidence. So you want to kind of, maximize, get the most out of your evidence with the minimum cost. So looking at your materiality levels, looking at what accounts you should look at, and then what do you got to pull. So in order to do all that stuff, you do have to understand the business, understand their internal controls, and what level of risk it is. The higher the risk, obviously, probably the more evidence we're going to have to pull. Then we're going to actually perform our test of controls to understand, again, that internal control structure, which again helps us to assess our level of risk. We're going to perform analytical procedures and test of details of balances. So our analytical procedures consist of like looking at the financial information and then just kind of, get comfortable with that account balance. So we've got, like an example would be like if we're looking at our sales transactions and our accounts receivable, the auditor's going to look at a sales journal for any unusually large amounts, compare those to the monthly sales, and just kind of make sure that everything seems reasonable. Then there's going to be a test of the detail of the balances. So then those are going to be where you're actually physically looking at something on the financial statements, such as accounts receivable. And with accounts receivable, you can do third-party confirmations. So you can, again, take your highest customers, the customers that have the most owed to the client, and actually confirm those and send them a letter. It says, hey, as of the end of the year, these are the invoices that we think are outstanding with our client, please confirm. And that's the best way to do it, because then you have an outside third party confirming what they're showing on their books. And then you're going to obviously complete the audit and issue an opinion about those financial statements. Again, it's that overall conclusion, whether the financial statements are fairly presented. And that's always based on your professional judgment. Again, never a guarantee. Okay, so that is our audit process, kind of going through the audit responsibilities and the objectives.